Today's webinar was created in May of 2022 and is provided by Tranquilli Financial Advisor, LLC for educational use only. The opinions expressed herein are as of the date of the report and meeting and are subject to change without notice. Forward-looking statements cannot be guaranteed. This material should not be considered financial advice or the offer to sell any product. Tranquilli Financial Advisor and Beacon Capital Management reserve the right to modify our current investment strategies and techniques based on the changing market dynamics or client needs. There is no guarantee that the assessments during the meeting of investments will be accurate. The discussion, outlooks, and viewpoints featured are not intended to be investment advice and do not take into account the specific client investment objectives. Before investing, you should consider his or her investment goals and risk comfort levels and consult our investment advisor and tax professional. Information has been obtained from sources believed to be reliable, but its accuracy and completeness are not guaranteed. Past performance is no guarantee of future results. Thank you all for hanging on while I read through that, and of course logged back in. I apologize for my camera level. I'll adjust it as I can with my laptop. Again, the office internet went out just as soon as I started the meeting. So with that, let me reintroduce Chris Cook, who has been on a number of our videos with us. I really appreciate Chris jumping on this meeting so quickly. It was not planned to go. However, we wanted to make sure that we shared with everyone what's happening at Beacon Capital Management within their portfolios. Chris is the founder of Beacon Capital Management. I've had the pleasure of working with Chris with Beacon Capital Management for over a decade now. Appreciate their methodology. We're going to get into that. So Chris, welcome. Glad to have you here. Thanks for working through the technology issues. And I will let everyone know that if I drop off, I'm going to ask Chris to just keep speaking while I relog a personal hotspot to make sure that we can run this meeting efficiently. Also, I will just reintroduce Mitch Fisher. You have received an email introducing Mitch about 2 months ago, and we're really glad to have him. Joined us from Axos Advisor Services. As I've said in email, he comes from the other side of the phone, and he knows how we like to work, how we like to treat everyone. So really glad to have Mitch again joining us. And let's get into it, Chris. So today, what we're going to accomplish, we are going to talk about it is a topic that out in the world, we'll say, there's a lot of discussion about. So we're definitely going to cover stop loss, why it isn't perfect, but why it is a good part of portfolios if clients own that specifically. Where the funds go after a stop loss, and then very timely discussion of the reentry. How do you get back in? That is the question of the day. I would share with you that I had several people reach out to me after requesting questions, almost the exact same question by those people. I have one deviation of it that we'll get to as well. And then the outlook, Beacon's outlook for the remainder of 2022. So Chris, now I'll let you say hello. Thanks.
Hi, everyone. Thanks, Lou, for having me.
You bet. Always glad to. So with that, why don't we go to the stop loss? If you would, give a brief reasoning why you created portfolios that have a stop loss, the thought process.
Yeah, sure. It's a good question. So usually what happens is we see most studies that are done out there on asset allocation or investments are centered around buy and hold, because the concept is the market always comes back. And there's not a whole lot of debate around that, including not from me either. The markets do come back. It's just a matter of how long does it take for them to come back. And most of the clients that we work with, fall into the category of just not having enough time on their hands to wait for that rebound, particularly if they're taking money out. That compounds the losses to the downside. Or they fall into the situation of they've gotten to the point where they're happy, and the risk of losing money is much greater to them than not making as much as they could, down the line. So we want to stop the losses before they get devastating. And, we've seen this, a couple of times, particularly back in 2000 with the dot-com bubbles. We effectively had about 13 years starting in March of 2000 before the market actually reached another new high. We didn't make any money for 13 years. That's a long time. And that really isn't too bad. Historically, if you look at secular bear markets, they last about 19 years on average before you break even. So, again, the clients that we're working with, they just don't want to wait 19 years to get back to break even. So we try to stop those losses before they get more catastrophic.
And with that, I want to share with everyone here's live, listening to this at a later date, the concept that Tranquilli Financial Advisor, I had worked through that 2000 to 2002 tech meltdown, the only 3 years in the history of the stock market that it dropped 3 consecutive years. And then add 2008 on top of that. And I'll say enough was enough kind of thing, where we're having these run-ups to only see it then, run down.
Mm-hmm.
So Chris and I were, if you will, seeking a similar solution. I didn't want to build my own portfolios. So we're glad that Chris chose this path of not wanting to wait, we'll say the 19 years. And I couldn't agree more that it is an important part of the portfolio. Now, we talked about this beforehand, Chris, and I, as you know, don't like to prepare for our meetings. I like to really do it off the cuff so that it is a good conversation and conversational. But we did talk a little bit about why it's not perfect. And if you would, share why it's not perfect.
Yeah, absolutely. I mean, I wish I could say that I figured out some perfect solution out there, but to be honest, if I did, I'd probably just keep it to myself. And
keep winning the lottery. Yeah, that's right.
That's right. That's exactly right. So, the stop loss theory, when the portfolio drops by 10%, that's when we run and hide. We go into what we call defensive or protection mode and shift assets out of the equity markets. And, usually a couple of questions come up as to, why 10% is usually the first question. And it's based on history of the markets. It's just probabilities. When the market drops by 10%, that's kind of the median, which means it's 50-50 chance from that point that it's going to go into a full-blown bear market, which means minus 20% or more. So minus 20%, minus 30, 40, 2002 was 48%, 2008 was 56%, 2020 is 35%. So about half the time, that's when you get into those deep bear markets that really cause lasting, effects on a portfolio. Now, the part that's not perfect is the other 50% of the time, right? Where it's just a correction. That means the market falls somewhere between 10% and 20%, and then it rebounds, usually pretty quick. And those are times where we probably should just hunker down, cover our head, weather the storm and come out the other side. The unfortunate part is we don't know which situation we're in at the time. So we have to make a call. And the call for our portfolios is always to err on the side of conservative and just assume that we're prepping for that bear market time. And if it turns out just to be a correction, it's not as though we lost more money. Where we're losing potentially is our opportunity. That means the market came back and we didn't make as much as we could have. But that's usually the objectives. If we talk to our clients on a whole, they tend to prioritize their objectives, this way. The first is, Chris, don't lose my money. And then number 2 objective, make as much as you can after that.
Excellent. And again, same concept. I don't sit with clients and Tranquilli Financial Advisor doesn't take the approach of we're trying to beat the market, we're trying to match the market. What we're trying to do is manage risk. And I think if we took Beacon Capital Management and just defined it briefly, it's risk management. That's the concept behind the whole thing. I subscribe to that. What good is, and I'll use real returns, Chris, for everyone here. What good is earning 156% in one year if the next year you drop 55%? 156% sounds remarkable, and I'll use a real life example. If you had $1 million and you earned 156%, you now have $2,560,000. Well, take off 55% of that, and you've basically broken even you're just slightly above even for those 2 years with a 156% return in year one. Those are real numbers, by the way. You can look up AARK. Right? So anyway.
What that proves, Lou, real quick, is just a basic principle. It's not really a philosophy. It's just fact. It's math, just grade school math.
Yeah, that's right.
Losses are more powerful than gains. So the 55% loss, took away, the giant gain, the 156%, gain.
Correct. That's correct. So, and that's what we're getting at here. And what we want to get into is now we've stopped out. What happens next? And if you could, again, give us a brief description of what happens at Beacon Capital Management after the stop loss.
Sure. So once we trigger that stop at 10%, so that's where we're monitoring our 11 sector portfolio that's equally weighted. So we're not making bets to start with on any part of the economy. So instead of having 25% of our portfolio in tech, like the S&P 500 or a lot of other market indexes do, we're only giving it 9.09% to each sector. And that's what we always call our first line of defense. And this year in particular, it's really held up, just amazingly, to be honest with you, really because of a couple sectors. Energy and utilities have held up and actually moved up a little bit so far this year. So we didn't really get to that 10% drop until early May 9th, I guess, is where we actually made that transition. So since then, on May 9th, that's when we started trading and we sold off those 11 sectors. And we would normally go over into fixed income that's allocated equally across long-term bonds, intermediate-term bonds, and short-term bonds. Now, this was an unusual case this particular year because we also have a stop or defense mechanisms on our bond portfolios. And the bond portfolio had already gone very, very defensive in the first quarter. So back in March, we had sold off all of our long-term, all of our intermediate term, which are more aggressive when it comes to bond investments. They just move more generally. When the bond market moves, the longer the term of the bond, the more it's going to move up or down. So the bond portfolio was already very, very short. So this transition went from equities to a really defensive position on the bond side. And again, I guess I failed to mention that the reason for that, bonds in the first quarter of 2022 experienced its worst quarter in decades, honestly. It was down over 9%. So, and that's a really big move in the bond market. So that's why that bond portfolio is so defensive. So that's where, we've been hiding effectively ever since and making it a little bit over there. As the stock market's gotten more volatile, the bond market has stabilized and it's moving up slightly, not a lot, because it still has a lot of headwinds from the Fed. The Fed is talking about raising rates, taking away some of the easy money off their balance sheets. So it's putting pressure on bonds. But the good news is we're still seeing the old trends that are tried and true, that when the stock market gets really volatile, we see this flight to safety over to bonds, because the largest money managers in the world, institutions out there, they're not going to go to cash. They just can't. Cash pays nothing. So, you guarantee a negative rate of return effectively by the time they have any expenses. So we're still experiencing that, just not as great as we normally would.
Okay, so I'm going to summarize if I can, because I follow all that. We've been through this, and I hope no one minds me giving a summary of that. You're agnostic to investments. You're not saying we like tech, so we're going to buy tech, or we don't like tech, so we're going to go to the bonds, the bond market. We're going to equally invest in these 11 exchange traded funds, which make up the sectors of index, the S&P 500. You're completely agnostic to specific areas of investing. What you, again, back to risk, you are concerned with and you are focused on is how do you spread the risk of a portfolio? And you've chosen to do it over these 11 ETFs when invested in the stock market. When not invested, you're simply shifting over to we'll say the goal is to shift over to the 3 bond portfolios, short, mid, and long. But in a case like now, where you've had a bad bond market as well, a negative bond, significantly negative bond market, that moved right into 1 to 3 month Treasury securities, correct?
Yes, very, very short term.
All right. So you chose the sectors of ETFs that you invested in or built your portfolios on as the Standard & Poor's 500, a very recognizable index. So you chose that because it covers such a significant sampling of firms to invest in. I think so because of the fact that when you chose these 11 exchange traded funds, it also, instead of only owning 500 securities, and I won't give an exact count for compliance purposes, but it's over 3,000 that are usually owned in your portfolios.
Yes, it does give us a higher level of diversification.
Okay. So we've covered now why you created it, why you chose 10%, because nearly half the time that it drops 10, it drops 20. We've covered what's in the portfolio, the stop loss trigger, and now you're going to tell us how do you get back in? Because that's the question I get all the time. And I want you to answer that question, Chris. And then I just want to comment on the commentary that's out in the world about stop loss. Okay. So
Sure.
How you get back in, please.
Yeah. So the get back in part is usually the more complicated piece. And it's really based on 2 factors. It's time and rebound. So how long does it take that 11 sector portfolio that we were invested in? How long does it take to reach its bottom? Where does it finally reach its low point? So we continue to track it like it's fully invested. In fact, we have kind of a shadow portfolio that is 100% invested all the time. Doesn't matter what happens with the stock market or with the stop loss part. When it hits its bottom, that's when we mark it in terms of days. How long did it take us to get there? And that will tell us how much of a rebound we need to get back in. So if it bottoms out really fast, we'll need about a 15% return rebound from that bottom point to get back into those 11 sectors. But if it takes a long time, it'll gradually grow. Every day that it takes to reach a new low, a new bottom, the more we're going to need to get back in. So 2 examples that we always use is 1987. So it was a crash, basically like one day bear market. But the good thing about it was that was it. The market, it just tore the Band-Aid off. It hurt, but it was over and it rebounded fairly quickly after that. And as we moved into 1988, we're already starting to hit new highs in a lot of sectors. And then eventually the whole market reached a new high shortly after. Now you compare that to the dot-com bubble or the tech bubble of 2000, started in March of 2000. We didn't really have a bad day, or quite honestly, we didn't have a horrible month, nothing out of the ordinary. It's just that we had, 2.5 years of it, where the market was just kind of dripping down slowly but surely. And a lot of research came out in the mid 2000s after that, and they started to figure out, one thing. It wasn't the amount of decline that really leaves a significant mark on investors and the marketplace as a whole. It was how long did it last? Kind of how much scar tissue does it leave, right? So, like I said before, you tear off the Band-Aid and it kind of hurts, but it's over, and you're able to get your head around it and move on with your life. The market does that as well. But if you live with something for a long time, psychologically, you start to think to yourself, is this ever going to end? Or, it's rebounding, but it seems to always go down now. And that's where the theory started to come from in terms of needing a bigger rebound based on the time. Now, one of the things that comes up that's a common question is, oh, Chris, that seems like a big rebound. You're giving up a lot, right? And, the answer to that is yes. I mean, we can. But one of the things to remember is the rebound is based off of that low point. So when the market falls significantly, even if we're waiting for a 15, 20% rebound to get back in, that will be significantly lower than where we sold out. If it's a bear market, we will typically get in lower than where we sold out. Now, if it's a little correction, we may give up a little bit in the spread.
Sure. And we've seen that in the past, Chris, and in the recent past, 2020. If we stop loss out at, and we always have to say approximately 10%, because I don't guarantee you what the number will be, but that's the goal, but it can be a little bit less. We've had that in the past. Stopped out, lower loss, 8%, I think 8.5% the first time I ever experienced it. But then we could have a 2020 where it's more like 11.5 or so. And then once the bond stopped out, even a little bit more than that. However, market down nearly 35%. As it started to creep back up, you reinvested, but you didn't reinvest when it was down, let's say 12%, where we had stopped out. You reinvested well before that. So we were in, if you will, at a lower point of the market. I would call that the concept in total. So I know there'll be people that'll listen and say, well, yeah, he's waiting 15%. That's the imperfection, if you will, that we talked about earlier as well, that there is no perfect investment. We would love for you to call the bottom, invest on the exact right day. That's not realistic. That's been proven to not work time and again. So what I'm getting at, and why I wanted to comment on the commentators, this Beacon Capital Management's method of operation is designed to manage that risk again. And it's designed to manage it in so many ways. It's brilliant because, in my opinion, the risk mitigation, the equal weighted of holdings, the reason behind the stop loss being 10%, and then the methodology of getting back in has so much merit. I think it has to be considered a part of portfolios. It may not be for everybody, but it has to be considered a part of portfolios. That stop loss is worthwhile because, again, go back to what you said about the 19 years. We just don't want that. I don't want to wait the 4 years it took from 08 to 12. Okay, that was painful to watch that. And by the way, I was around for that last bond meltdown. I believe it was 1996 when that occurred. And that was, again, a lesson that I talked about on here before. So you'll hear this, and it's to answer one of the questions directly. Why would you sell low? Or why would you sell when you're at the low? You're supposed to ride through it. You're supposed to buy low, sell high. Well, no one said we were selling at the low. The 10% may not be the low. It could be, but again, using real examples, we weren't at the low even in this current environment. We touched the bear market a few days ago, and we're not recovering, even though I know today is a good day. So my point being is that you don't know what the low is, and that's the risk that you have to decide how much of that you want to accept. So yes, there's commentary. You should never sell. You should ride through it. Well, that may be true for parts of the portfolio, but not all of the portfolio as you and I see it moving forward. So I think that sums it up. I think you can correct me on that.
Well, and the history on our portfolios kind of follow the market history. I mean, I was referencing About half the time the market goes into a bear market, that's a 100-year history that I'm referencing. And, our portfolios follow the same probabilities. About half the time we stop out. Probably could have rode that out. No harm, no foul. But half the time so far, it's turned into something real. And we're glad we did it.
Yes. And I think it's fully compliant to say that we're not trying to be right every time. We're trying to be right. And when we're right, we're trying to be really, really right. Or correct. Okay.
Yeah.
Very, very correct.
One of the things that's hard to do, and why we want to wait for kind of a new trend to be confirmed before we get back in, is that, when the markets do fall, it's called a bear trap. So effectively, when the markets go into bear market territory, they will rebound up. So, you'll find the bargain hunters out there. They'll say, hey, there's lots of cheap stocks out there. Let's move in. And, the market will naturally bump its way back up. And the problem is where those bargain hunters are, they make their spread really quick and then they get back out and then the market falls back down again. So you want to make sure that you've got a longer term trend, because sometimes you buy back in just to make a couple bucks and then it rolls back over again to the wrong direction. And we've already seen it this year. The S&P, fell about 16, 17% or so. It rebounded a lot. It was approaching a new high again this year. And then all of a sudden, well, now where it is until the last couple of days, it was down 20% at one point, since then.
We want to avoid, the term is whipsaw. We want to be whipsawed. So with that, and I promised everybody about a half an hour, and we're a little bit more than that, even with the tech glitch in here. Although you're not, we'll call it the market timer or anything like that, you're not selecting individual securities. Your outlook as someone who is managing other people's money and looking at this all the time, outlook for the remainder of 2022. Please get your thought. These are Chris Cook's thoughts on the stock market 2022.
Yeah, so as everybody probably knows, it's, seen or heard me before here. I'm not much of a forecaster. I tend to lean on market probabilities in terms of what's happened in the past. But, I do obviously have an opinion on the market. And the way I'm looking at it is the Fed has pretty much laid out their playbook, at least through the summer, through the end of July. They've effectively said, and they confirmed it even yesterday with their minutes, their latest minutes that came out, that they're going to raise at least 50 basis points in the next few meetings. That gets us through July, so most of the summer. As long as they're doing that, there's going to be a pretty significant headwind to the markets, both sides, stocks and bonds. And I'm not really seeing, what's going to give the stock market, a spark to really rebound at this particular time, because the big issue out there is inflation. That's the only word that I hear every single day right now. Where a couple of years ago the only thing you heard about was COVID, and various shutdowns and everything was related to COVID. Now suddenly it's inflation,
and next up it'll be recession.
Yes, and it's already starting to come up. Probabilities are getting higher by some pretty respected economists out there. And a couple of things that come to mind that have happened just recently. It was last week when this latest fall in the market came out. Is Walmart and Target both released their earnings within 24 hours of each other, and their sales were fine, hit every expectation on the sales numbers. So people are still, going to the stores and spending money, but their earnings got crushed. And both said the reason for it was because all of the costs associated with buying the goods themselves and transporting the goods went up significantly and more than they had anticipated. And, these are really smart people that are running, these companies. It's Walmart and Target. They've been around the block a few times. So,
right. If they're surprised, we should all be surprised.
Yeah, exactly. So, and basically the scenario is they're eating it right now. They're not passing those costs on to the customer. But again, the way I'm looking at it from a business perspective, they're only going to do that for so long. And they will have to pass along some of those costs. So if some of these supply chain issues don't get cleared up, basically that means China doesn't start opening up, fully and just living with COVID like the rest of the world is right now. And we don't get a grip on some of the energy costs, gasoline and diesel. Diesel fuel prices right now, I think, are about $5.75 or so. So we don't get control of those things. They're going to start passing along at least part of those costs. So my point is the current inflation numbers don't register any of that because the companies are eating it. If they start doing that, those prices will start to show up. And just Walmart by itself is big enough to hit the needle on the inflation gauges. So if that's the main concern, inflation, I just don't see how it's going to go away in the next few months. So, I really would anticipate not a lot happening consistently through at least the end of the summer. And then maybe we'll take it from there. Some things are slowing down. Interest rates have slowed down mortgages and some different loans, home buying, things like that. So maybe that'll be enough, but I just don't think so.
Okay, well, good. That is the commentary I was looking for, and I do appreciate it. Of course, appreciate this time and the ability to, we'll say, refresh the memory or the conversation of why a stop loss, why it can be effective, how we get back in. And for everyone here, if you'd like to ask questions, you have my calendar link. Certainly put yourself on the calendar. Always glad to do it. Send me an email. Let me know if you are enjoying these conversations, because I do enjoy having Chris on and the others that we talk to. And for those of you listening after the fact, please send any additional questions, schedule a call. Chris, thanks again. I don't know if you want to add any additional comments to finish off, or if you're good there. I will just say that different theories in portfolios make up the Tranquilli Financial Advisor overall theory. Beacon Capital Management being one of those theories that are part of the equation when building client portfolios. So I really enjoy having different theories working on it. You just heard I'd say a unique take from Chris Cook. So please reach out if you have anything else that you'd like to talk to specific to today's conversation, or of course, it's always just glad to talk. Chris, thanks again.
Thank you.
Okay. Thank you, everybody, for joining us. And we'll have certainly have more of these to finish out 2022. We'll bring Chris back beginning of the fall, and we'll make him revisit those comments that he just had for us. That's a joke. All right. Thanks so much again, Chris.
Thanks. We'll see you guys.
All righty.